So what I'd like to do to start off is to ask our panelists to introduce themselves. And I'll start with Oliver Gibson to introduce himself, his role, and the company he works for.
Thank you very much, Bridge. Delighted to be here. So my name is Oliver Gibson, as Bridge said. I'm the EMEA Sales Director at Crystal Global Research and Risk Solutions. We're part of the S&P Global family, and we work with financial institutions across the world, helping them build out their capabilities and reduce costs across three verticals: research, risk, and data analytics. ESG is obviously a big part of that and a growing part of our business. So we're very much helping clients integrate ESG into their investment process, build out their capabilities, and so obviously have some interesting insight directly from dealing with clients that I look forward to discussing today.
Excellent. Thank you very much, Oliver. Looking forward to discussion with you. I could then move on to Hamish Risk to give his background and profile.
Thanks, Bridge. Good afternoon, everyone. Delighted to be here today. So I'm one of the founding members of Substantive Research, and we're a research price and quality monitoring service. So in layman's terms, it's essentially we're a comparethemarket.com for the investment research market. So we work with about 60 plus global asset managers and who manage about sort of 10 trillion in assets. Where we come at the ESG issue is, if you think about it in terms of the marketplace, ESG is obviously not a new idea, but now what we have is, this global mass adoption of ESG, and the marketplace is relatively small. So we're going to see a lot of new entrants into the space, and what we do a lot of is research discovery. And so what we'll help asset managers do is, find the best fit inputs for their process.
Excellent. Thank you very much, Hamish. And last but not least, Ben Webster.
Hi, everybody. I'm one of the founders and I'm the CEO of Owl Analytics. We are a ESG data and analytics company. We work with some of the largest asset managers, hedge funds, asset owners, insurance companies, and global banks in the world. We're well known for kind of our core ESG product, which are our Apple ESG ratings that are, a lot of them, they're really known as kind of the wisdom of the crowd or the consensus-based ESG ratings that aggregate hundreds of sources of ESG data, information, research, and ratings, and kind of scores companies on the wisdom of the crowds type of view. We have lots of other ESG capabilities, which I'm happy to talk about offline, but excited to be on this webinar and love to hopefully educate anyone who's joining on ESG and how you can look at ESG as part of your investment process.
Excellent. Thank you very much, Ben, and thank you to our panelists for the introductions. Before we jump too far in and dive deep into the tech sector, just a bit of benchmarking and a bit of background. We do a buy-side study every year. Last year, we spoke to 400 buy-side managers, and over 70 or 80%, I think it was 79% of those said ESG was one of their top 3 priorities in terms of getting ESG integrated into the investment decision-making process. But when we also asked them what are their top 3 challenges, they also said integrating ESG into the investment decision-making process. Ollie, where are we from an ESG perspective? Where does it sit now within the investment decision-making workflow?
Yeah, absolutely. So I hear exactly the same thing from my clients, and really it has been accelerated since the start of the year. So a couple of years ago, everybody was looking at ESG from a negative screening tool, and now it's very much going even further and being looked at holistically. And actually, ESG factors now are being incorporated into the investment process to identify risks, and even looking at new opportunities and how you can actually work with a company, how you can influence a company to improve its ESG credentials, and hopefully make it a more profitable and successful company as well.
Excellent, thank you. So Hamish, we seem to have gone from this being something that's very at the top or sits slightly adjacent to the investment decision-making process, either as a screen or something that you do before you start making investment decisions. like, how are buy-side firms thinking about this from in terms of resourcing? Like, what research do I need to help support this now it's getting closer and closer to that decision-making sort of element of the workflow?
Yeah, look, it's really interesting area. I mean, there was a survey actually out yesterday from Russell Investments that looked at this and the level of integration that's going on. And, it shows that still, 50% of the resource is coming internally and the external resource, is somewhat less than that, but it's growing. So, and what we're seeing, certainly from our clients' budgets is that, they are allocating more of their budget to ESG. So that is growing. And really that has only happened in the last sort of 12 months. I think when we talk to our clients, it's a bit of a race against time, obviously, because you've got this regulatory tailwind that's coming, and Europe will be imposed sort of in March next year. So, when we talk to clients, it's we're sort of 70, typical answers, we're 75% there, we're 90% there. We've got a lot of frustrations, obviously. People still look at there's a lot of discrepancy in the data and the integrity of the data, subjectivity. But, more and more, as I said in my, opening intro, we're going to see a much bigger requirement for, external resource, and that will take up a larger share of research budgets going forward.
Thank you very much. And Ben, just to sort of pick up on some of those points, your larger components of budget going to ESG. Like, where do you see some of the key challenges of integrating ESG into the decision-making process from your clients? Is it a data problem? Is it a content or a narrative problem? Where are these issues really sitting?
That's a great question. Not to oversimplify, but I think overall, it's really the concept of they're used to investing in a certain way. They have certain, concepts, ideas, rules that they most often rigorously apply to their investment process, and ESG is just foreign to them. They don't know. They don't know where to start. Even they don't know if they do something with ESG, is it going to, in their minds, potentially hurt returns or alter the risk of the portfolio. There's just a whole world of issues to consider. It's actually quite difficult, but once you kind of create the foundation of how to do it, you can do it in a rules-based fashion as well. So there is work up front to do, but once you do that work up front and you identify how to do it and what that potentially means for the risk or return of your portfolio, and oftentimes from my clients, they hear that it improves the risk and return of their portfolio if they're doing it in the correct manner. It can be applied, systematically, just like other rules. So that's kind of I wish I had a simple answer, but it takes some work, but once you do that work, it pays off.
Yeah, it's a great point that this isn't just about risk profiling anymore. There is opportunity, if you get this right, to identify ethical alpha performance, if you will, if you align this correctly and you have a proper framework and approach to doing this. One of the challenges we often hear is that it's fine for certain sectors. Certain sectors you need an ESG profile, but tech's not one of those. Like, tech is at worst ESG neutral, but at best ESG positive. Ben, I just want to pick up with you first of all. Like, what's your view? I mean, we look at all these large ethical ETFs, and they're all massively overweighted in tech. We look at the tech sector overall, and we generally have a warm, fuzzy feeling it's doing good for the world. Like, is that correct? Is there a risk in thinking about it that way?
I mean, there is a risk, right? And I definitely want to separate stock performance from operational performance. Stock performance, how ESG affects stock performance is in two primary ways. One is obviously operational performance will end up affecting stock performance, right? But that's the first order effect. A second order effect is how market views investors view ESG, and how their views of ESG influence stock prices through supply and demand. So I definitely think that my opinion is that a lot of the tech stocks definitely have, especially the mega caps, have large very good ESG performance. And as a result, it's to some extent a little bit of a coincidence that that a lot of ETFs, that are market cap weighted, have in general a pretty good weighted average ESG scores across those portfolios. What caused it? Was it because they had better ESG profiles? Probably not. I think it's more because people are putting a lot of money in heavily market cap weighted types of products. That's somewhat of a coincidence, but there's a danger there, right? There's a danger that if some of those tech stocks come back down to reality, maybe they will, maybe they won't. And your perception of reality, everyone's is different. But let's just say there is some sort of a correction in the valuation of those tech stocks. The market may perceive that, oh, there's a crash in ESG, right? So there's a lot of ways to look at it, and I would encourage that you need to look at it at both lenses. You need to look at primarily ESG's effect on the operational performance of companies, and secondly, you got to be aware of the risks of how the market could view ESG as being overvalued or undervalued. Again, it comes down to supply and demand, and doesn't mean that ESG doesn't, just because ESG stocks crash, doesn't mean that ESG does not necessarily contribute to operational outperformance of peers.
It's a great point. Thank you. Ollie, when we sort of think about sort of considering ESG risk, we typically sort of start to think about what data do I need? And getting some data for this and hoping that that's going to be enough. I can get an E score, I can get an S score, I can get a G score. I can put them together, maybe some different weightings based upon maybe environmental is more important for certain sectors over others. From a tech sector perspective, do you feel that people need to go further than that, other than just simply getting an ESG score? Do your clients typically go deeper than that when they're thinking about this?
Yeah, absolutely. I think it differs across all clients. I mean, I think lots of people are at different stages in this process. A lot of the big names in asset management have invested heavily and are a lot further along than certainly some of the mid-tier and smaller tier asset managers. But I think there is a risk of greenwashing tech companies if you do sort of look at the environmental aspect, which obviously has been a core focus at the start of this sort of ESG process. But actually, if you look at the social and governance aspects of technology companies, they're pretty much equally weighted along the line of other sort of sectors. So, I mean, if you look at the COVID sort of situation, I mean, in the news, I mean, Amazon, Wirecard, over the past sort of 6 months, we've seen a lot of issues raised on the governance and social sides of not treating employees properly, disregard for their safety during COVID situations. So I think it's a major risk not to look at the E, the S, and the G. And the way that we're sort of seeing the more developed and more advanced ESG clients of ours is that they are really starting to look at companies closely. And a lot of them are using materiality frameworks to really sort of build out the comprehensive assessment of that company. I mean, if you rely on just what's available from data providers and what's reported by companies, it really doesn't give you much of a picture. I mean, if you look at Roche, for example, I know it's not a tech company, but it's a highly positive and highly sort of rated ESG healthcare company. If you use a materiality metrics like SASB and use what's reported from Roche, you can sort of build up a model and a map of about 20% of the data. So what we've been doing for a lot of clients is actually using secondary sources to further build out the data that's available and build out that map on a company like Roche. And we did that recently for a client, and we were able to improve the data quality up to about 60% of that mapping, which obviously gives you a lot better understanding of the company and risks and opportunities associated from an ESG perspective.
And do you feel that that's going to improve and enhance the standards that we have, like SASB, or do you feel that there's always going to be an element of ESG analysis that sits outside of a framework and it will just be because?
Yes, I mean a lot of clients are using SASB. A lot of clients are using SASB and then building their own sort of frameworks. I think to have the best approach, you need something standardized across the business. So doing ESG research outside of a framework, it's certainly. I think most of our clients want to sort of focus on a framework and have a standardized approach across the business. So everybody's looking at companies in exactly the same way.
So Hamish, it feels like the conclusion I'm hearing from both Ben and Ollie is that ESG is impactful for tech. Tech certainly isn't neutral on ESG, and it's valuable to sort of think about this. From an investor perspective, you and I are both thematic guys. Are there specific themes that we can start to bucket these factors into from a tech perspective?
Yeah, absolutely. And you know, they tend to, you know, obviously change. And you know, I think what's interesting with COVID, you know, is that some of these issues have sort of perhaps changed the focus on what the key themes are, the key risks are. But you know, what I would say is, you know, data privacy. Obviously, data privacy, cybersecurity is, you know, the key material risk in tech, and you know that will always be by its very nature the case. You know, you can look at, you know, censorship as another issue. You know, this whole, and you know, very prevalent. Now, whether it's a material risk right now is another question. But you know, the whole balancing of free speech, you know, the eradication of false facts, hate speech, that sort of thing, you know, is a big issue. You know, we've already talked a little bit about labour relations, and you know, its importance in that. And you know, there's a lot of research out there that talks about how, you know, in some ways ESG tech stocks have, you know, been more favourable because, you know, they employ less people, so they have less problems. But you know, you just have to look at Amazon at the moment, for example, where there's some real big problems there, and you know, there's something that needs to be watched very closely. It's the humanisation of its you know, massive labour force now. So that's another one. Governance. You know, it's really interesting looking at, you know, when we talk about, you know, the E, the S, and the G. Governance is still the biggest, by far, the most important factor for investors. You know, if you look at the surveys, and that's what it shows. You know, this sort of the Silicon Valley bro culture, really interesting. You know, you look at, you know, Mark Zuckerberg's you know, majority voting power, and that as a result of Facebook's, you know, dual ownership structure, for example. That's just one thing, you know, that people look at. You know, the aggressive tax planning that you see with a lot of tech companies, another big issue, and that's been prevalent for a long time. And you know, there's a real push there to have greater transparency. You know, another interesting thing on the flip side, you know, is regulation, and you know, some of you may have seen this yesterday. That, the House Antitrust came up with this 450-page report, you know, charge sheet, if you like, big tech. Now you can argue that, well, you know, so there's going to be, you know, some regulation of the tech sector. You've got regulatory risk, regulatory burdens. You know, we saw what happened in the 90s with Microsoft. They tried to break up that company and its resulting share performance. But interestingly, ESG investors can look at this and go, well, actually, regulatory checks are probably a good thing, in principle, a good thing, because, you know, in this space and in the age of, you know, social media, they protect society and the planet, and you know, sort of encourage, you know, better, higher behaviour standards for the big tech firms. So, you know, there's you know, big differences. And I think one other thing I also mentioned, and I think it's quite interesting, is if you look at Ant Financial as a company that, you know, obviously going to be the biggest IPO in history, and you know, massive fintech firm, And the whole idea there is that they're bringing, liberalizing and making finance available to many. And so, there's an argument that that's greater societal good as well. There's both, pros and cons, I think, or headwinds and tailwinds for ESG in terms of the big ESG themes.
That's excellent. Thank you. Ben, sort of what we've heard there from Hamish is that you can think about ESG from a tech perspective thematically. So there's data privacy, there's governance issues, there's potentially climate issues there. There's employee satisfaction issues there. Like, how can we sort of take those big picture themes and then start to sort of distill those into underlying subcomponents of the score of a company to start to sort of think about how to sort of integrate this into the investment workflow?
That's a good question. So there's two ways to go about it. And there's no way that really, how do I say, is absolutely perfect. So one is, let's look at the raw data, right? Let's take data privacy as an issue. Let's look at incidences of data privacy issues at a company, right? And now, don't get me wrong, that's actually probably pretty easy to come by if there has been a very public data privacy issue for an extremely large company. But the problem there is if you're trying to compare a company based on a data privacy issue that got discovered, that the news found out about, but there could be hundreds of other data privacy incidents that never were discovered, that were swept under the rug, and the companies aren't reporting on it, aren't disclosing on that, right? So it's when, I'd be very careful to try to apply certain individual ESG issues uniformly across a whole sector or industry when you're just lacking the data, right? However, when there is a controversy of that nature, there are ESG controversy products out there, which are essentially like a kind of new sentiment controversies that can, very quickly inform you if a controversy has happened, how severe that controversy is, and you would be, obviously, that would be beneficial to be able to get access to a data of that type, to be aware of where your risks are in the portfolio. Now, the other option is the aggregation of similar types of incidences. So without referring to our data set, almost every major ESG data provider will have what they call an ESG key issue or an ESG factor library. We call them our KPIs. We have 12 of them. But in general, each of those factors or key issues, think of them almost as a theme that captures numerous potential data points relating to that issue. So I will relate to us because I'm most knowledgeable about us. So a data privacy issue could fall under multiple things. Management ethics, for example, is one of our KPIs. So, and the benefit of that is that, maybe not every tech company or in a certain industry or the tech sector will have had a data privacy issue, but many of them may have had some sort of management ethics issue, fraud or something. So by aggregating a lot of related thematic data points, you can then now more uniformly rate a company across a behavior. Now, obviously, as you aggregate, that's not an exact science, right? And every ratings provider, including us, will have a different way of rating a theme, right? And scoring a theme, and no way is perfect. But it does help you create a uniform way of looking at numerous companies in a group in different groupings, whether it's industry or sector. That could be more helpful than individual instances that can't be as widely applied. But again, there's pros and cons to each approach, and we think that there's value to both approaches. You just got to, like any tool, you got to learn how to apply that tool wisely.
Thanks, Ben. Ollie,
Well,
this smells and feels a lot like just good investor due diligence and just good fundamentals research of a company. And generally, the view is that investors who do better due diligence and have a better process of analyzing companies deliver better performance. Is that what we're hearing here?
Yeah, well, I certainly think, I mean, governance has been a key focus to most investors for a long time. And I think that is probably one of the, the most sort of important factors of ESG. I do sort of feel that that clients, as they look at this, as they sort of put the frameworks and structures in place, they are looking at it as ESG is another factor like growth and value that really needs to be taken into account. If you're looking at an automaker, for example, looking at what it's planning to do with its electrification and its fleet in the future can really sort of impact your forecasts on that company, revenue forecasts. So we're certainly sort of seeing clients taking ESG and looking at it as some of the traditional metrics that they would do in financial modeling and actually sort of coming up with an investment idea. So from our sort of perspective, it's being integrated further and further into the investment process. And I think going back to what Ben said, this is one of the challenges as you integrate it further into the investment process. There's more to do. And there isn't the data, there isn't the insight that you have, in sort of looking at it from other sort of metrics. So that is a big challenge. And then also you've got a credit analyst who's been looking at companies in a certain way for 30 years, and all of a sudden is being asked by the company to incorporate ESG into the investment process, which he's never done before. He's not that comfortable doing it. And the data and the tools that he has available doesn't give him all the information that he needs to do that analysis. So this is one of the big sort of challenges, and that's where we're sort of helping clients at the moment.
Amazing, thank you. I saw you, Hamish, you were nodding along there. Does this sort of ring true for your clients? They're finding it hard to resource and work out what content do I need to support this?
What I was going to say was, yes, the answer to that is yes, of course, but in what we do, monitoring the research market, we filter through, research from more than 400 research providers globally, and when we talk about ESG integration, that's taking place not just on the buy side, but on the sell side and with the analysts, and them, as Ollie says, they're having to adopt these new practices and integrate it into their research. And, on the buy side, you have, your typical portfolio manager, who might be, a middle-aged male who's been doing the same thing for, 20, 30 years. And, they sometimes can be resistant to change and to, change their process. And it's the same on the sell side as well. And so, what we see is that, over time, we're seeing more of ESG, integrated into the analysis. And as Ollie says, do they have the tools to provide that? Some do and some don't. And some of the big sell side firms obviously have invested a lot in data and also developing their own data sets to provide that, because they are the service providers and they have to come up to speed as well.
Yeah, absolutely. Before
just to add on that point, I mean, we're certainly sort of seeing that a lot from the sales side. Climate risk factors and ESG factors are being incorporated into credit risk modeling at the banks. So that's sort of a big area that we're sort of seeing, a big sort of push as they do really sort of see it as a potential risk from a credit perspective.
Thank you. Before I jump into sort of asking Ben my next question, I would also like to give our audience an opportunity as well to ask questions to our panelists. So if you'd like to ask a question, simply go into chat and then post a question either directly to me or to the entire group, and we will make sure we ask your questions directly to our group of panelists. Ben, just want to pick up on both those points that Hamish and Ollie mentioned. It feels like ESG is a data-driven process right now. It feels like like if you think about traditional investment research, sell side research, it's a PDF report, comes into your inbox, all that sort of fun stuff. ESG feels like it started in the digital era day one, and it has that sort of veneer of data science slash investment analysis. Is that fair?
I do think it's fair to a point. I think it's just because it's, like you said, it's the era in which it kind of has become more popular. I mean, but like you said, what is a report? A report typically starts with some sort of data, and then you have an analyst's interpretation of the data on top of that and put into some sort of narrative framework, right? And that's exactly what a lot of ESG research firms do. They take the data that they collect, they put a narrative framework on that. The problem is that the connection between an ESG data point, let's just say carbon emissions, right, and financial performance is not nearly as well known as the connections between earnings growth and financial performance. So when in a traditional, you were mentioning credit ratings, for example, in a traditional financial analysis, there's a very rigid framework that companies are reporting metrics upon, how they're reporting on metrics, where an analyst will have a very good source data from which to create apples to apples comparison, right? A normalized source data, they could see the same type of stats for all the companies they're analyzing on. There is no such standardization in ESG yet. There's been a lot of attempts at it, SASB being mentioned here as well. But even then, the vast majority of companies don't report by SASB standards. Even large and mega caps report some by SASB, some of the metrics by SASB standards and the way SASB wants them to, but not even then, not nearly what SASB wants them to across all of their ESG reporting. So it makes it very difficult to do that. And then as a result, it makes it very difficult to put those narrative reports together and truly build that framework or that story around the ESG-ness of a company. I think the nature of the data, the fact that it's not standardized, that it's not uniform, makes the analysis of ESG that much more difficult, and oftentimes requires much more advanced tools that can be employed in data science, machine learning, AI, the ability to take text and use NLP and generate sentiment and the mass intake of data to make the actual generation of some sort of knowledge much more efficient. It's just required now. Eventually, one day it will be standardized, and you can employ the traditional techniques. That's really hard to do that right now.
Thank you. Let's take an ideal scenario from Ben's description there, where we knew the data to capture, and all the companies that we cover capture every single metric themselves. So there's no gaps. But then you've still got the challenge of materiality there as well. So you've still got the challenge of how important is carbon emissions versus employee satisfaction versus charitable spending for the tech sector. How are your clients sort of thinking about actual weightings and consideration of materiality? Not just
within a materiality framework like SASB, then that's actually sort of set out for you. So if you look at it for the tech sector, I mean, I've actually got a few of the points here. It does look very closely at data privacy and freedom of expression, recruiting and managing a global and diverse workforce. All the sort of key metrics that do align to sort of tech. We sort of see that actually something like SASB. Ben is exactly 100% right. The problem is that the reported data at the moment doesn't really sort of touch the surface on SASB. So to actually give yourself a clear understanding, you've got to go and look at secondary sources. You've got to do a lot of research yourself to effectively build out that ESG model, and that's usually time consuming. And it's a challenge, and especially in an environment where costs are an issue across the buy side. People can't really be able to afford huge teams of analysts to build these types of ESG data models. So, we're having a huge amount of success in coming in and building ESG data models using frameworks like SASB for clients. It's standardized across the body of sort of clients, companies. So, it is giving a much more sort of structured insight. And then we're even sort of seeing clients take things even sort of further, sort of looking, for example, we've got clients looking at banks' loan books, to sort of see if if their loan books are reflecting the policies that those banks have set. If it's aligning with that asset management's coal policy. If it's not, can we start to influence that bank to, think differently about who it loans money to?
Yeah, absolutely. You're starting to get questions through from our audience, and we've had the same question come up a couple of times now already, which is, this feels like a battle of frameworks, and the question is, who's going to win? So who's going to answer that one for me?
I'll take a shot at that. I do think SASB has some level of edge in the battle of the frameworks, because they're really getting a lot of asset managers and companies involved, and really generating a lot of collaboration, and the tie to materiality. That they were founded from the beginning on, hey, you need to report on those ESG issues related to your company that are material to you or to your industry, right? So I think a lot of investors that message resonates with people. Now that said, it's going to be a long time before we really can tell who's going to win that. And I think I would bet on any standard organization that has a clear material framework, and SASB seems to have done a good job at that. But again, there's no guarantee. It's really at the start of the race. To be blunt, I think you need to be looking at a lot of different frameworks. I think if you're only looking things through the SASB lens, you're missing. You're going to very much miss other types of ESG viewpoints that could influence stock prices, that could influence the movement of money, right? So, for example, the EU taxonomy is coming out, and in December 2021, it will be put in effect for asset managers in the European Union, such that in order to call yourself a sustainable fund, you have to report on essentially what the EU taxonomy tells you need to report on. Now, weirdly, I think maybe they put the cart before the horse, because in December of 2022, that is when companies actually need to start officially disclosing in their official statements the ESG metrics that the taxonomy tells them that they need to report. So, definitely in the European Union, the EU taxonomy is going to win out, at least for now, because you're required by law to do so at that point. And so the point being is, if you're investing in a European stock, I was an analyst, I'd try to be aware of the EU taxonomy. So, I mean, ultimately, I'm not trying to make it sound more complex, extremely complex. I don't think it's that complex in reality. You just try to find data on what the company's doing regarding certain ESG issues. I think you need to make, you as an asset manager, you as an investor, need to make your own stand on what you think is material, right? And go from there, and develop either some expertise or work with consultants like some of our esteemed panel members to help you develop that framework that you feel fits what your vision is. And I think that will be your best way to approach this, one step at a time, and gain an advantage with every step you take, And then there's tools like ratings, like we have ratings, other ESG data providers have ratings, and those are tools that can help you as well. Like anything in life, don't look at necessarily just focus on the end goal, one step at a time, and you'll be that many steps ahead of your competitors.
Thank you. That's a very detailed answer. Appreciate that, Ben. Next question we've had from a audience member is, Hamish, how should investors be thinking about doing all the things that Ben has just described in terms of thinking about their research budget or thinking about a budget and a process to actually acquire the data they need? Is it a combination of taking 3 or 4 big providers, having your own team do analysis? Like, how should people be thinking about this from a resourcing perspective?
Yeah, so what I would say, obviously slightly talking my book, but obviously you need to do a fair bit of due diligence in terms of what the requirements are. I mean, what I would say also is, as I said at the top, really, it's a case of where you've got a huge amount of new entrants coming in. You've also got as has already been discussed. It's interesting, the growth of ESG is coming at a time where, everything is starting to be powered by AI and the use of that technology. So, it's a case of, understanding, what is out there, understanding the different data providers that have offerings, and, looking at the incumbents versus the new entrants, and just kind of being aware of what the alternatives are, because there's a lot of shift within the space. And then obviously a case too of looking at how you allocate the budget. So traditionally ESG has been this data product, and as I said at the top, it's now sort of a move to allocate it into research budget. So that's really crucial. So what is that? How do you allocate? How much budget are you allocating to it? And so to get back to this question about ESG integration, it's really interesting if you look at that and say, well, and someone says, ESG risk is, we take it seriously as we take any other financial risk. But if you look at the inputs into the process, it's disproportionately low. And so it's, so a lot of, debate about what proportion or how do we proportion our research budget into the ESG. So I think the bottom line basically it's build your awareness of what is out there, because we've had an industry where there's been a lot of, you've got a small set of incumbents and a lot of change going on.
Excellent, thank you. Very helpful, Hamish. Ollie, we had another question. Whose responsibility is ESG analysis? Is it the tech sector analyst's job? Is it somebody else sitting alongside them? Who's actually, from your experience, doing this work?
Yeah, so I think when people started to look at ESG, there was a thought of maybe having a dedicated ESG team, and that was very quickly realised that it just didn't really work. And with ESG, actually being a factor within the investment decision now, it has to be done by the analyst. So I would sort of say absolutely done by the tech analyst. So the way that we're working with clients is that we would support that tech analyst. So we might build ESG models for them, do underlying research. A client could effectively build up an ESG team using our analysts. So we would act as an extension of their team, doing a lot of that ESG analysis, which is time consuming. You have to have knowledge of where the different sources are available, and actually sort of putting that together. So that tech analyst can literally sort of take that ESG model, that assessment, that due diligence that you've done, and very quickly and easily incorporate it into their investment process. And then obviously questions about that, they can speak with our analysts directly about that. So that's how we're sort of helping with that challenge.
Excellent, thank you very much. Just looking, one final question we have, perhaps I'll direct this to Ben. Ben, are you aware of the Impact Weighted Accounts Initiative at Harvard Business School? And do you have any views on this?
I am aware of it. Unfortunately, I wish I could give more views. I haven't had the time to really roll up my sleeves and delve into it. But I will say that there are a lot of esteemed research professors at Harvard putting out a lot of great white papers, and you should really, I think, as investors that care about ESG, you should really pay attention to those and others, because they're doing a lot of work on the material connections between certain ESG data points and materiality. So, SASB is great. It's created a great material framework. However, there's just so much more research to be done to validate what SASB is saying, and a lot of great work is coming out of Harvard, but I don't have any specific knowledge or insight into that specific project.
Thank you. Appreciate that. What I'd like to do now, as we sort of come towards the last 10 minutes of our discussion, is really give each of our panelists an opportunity to talk about where do we go from here? Like, where do we see ESG and tech sector integrating to actually deliver actual investor value, which is ultimately what the investment role is. I'd like to sort of start, if I may, with you, Ollie. Just sort of talk us through where are we and where do we go from here?
Yeah, I think we are at the start of the road, and as I said, a lot of asset managers and well, people across the financial industries in general are at very, very different stages. So, if you are right at the start of this, I think it's important to look at frameworks, to look at materiality metrics. We're sort of seeing a lot of clients using SASB, but then a lot of clients are developing their own frameworks or using SASB as a starting point and developing on that. So, build the frameworks, get the scorecards and screening tools in sort of place. And then if you want to integrate ESG sort of further, really start looking at doing, using that metrics to build ESG models, using primary and secondary sources. So we use government databases, NGO sort of websites and sources. I mean, even using websites like Glassdoor to give you insight into the employees of that company and their insights can help you build up a more comprehensive overview of a company. We're seeing a lot more engagement and influencing of companies' strategies around the ESG. So we develop a lot of questionnaires for our portfolio management clients. So when they are speaking with the management of the company, they know where the gaps are. They know the questions that they need to ask to fully help them build a comprehensive ESG model, helping them with proxy voting support for funds. And then again, I mean, there's a lot of work that goes into actually educating clients about ESG, highlighting what you're doing across the firms. So we do a lot of white papers. So we effectively do white labeled white paper research and the actual production of that white paper for different asset managers, for different banks that they use to attract clients, educate their clients on what they're doing and how they're looking at the world. Excellent.
Thank you very much. Ben, I think same question to you really, like what's the conclusion here? How do we integrate ESG effectively to deliver performance?
Maybe go to the next slide. This slide is titled our product suite, but taking a step back, you'll see we have a lot of products, a lot of different ESG products. And that's the important thing to note is that right now, there are a lot of different types of ESG data, ratings, and information and research out there. All of them can be used for similar things and for different things. Taking a step back, it's important to note that a lot of times you may have clients that want you to integrate ESG and sustainability and social responsibility and how you manage money. And sometimes the way you overlay ESG into how you invest could be dictated by their ethical considerations, right? So they may, for example, we have a controversial product involvement, basically saying, okay, if you don't believe in and you don't want to be exposed to any companies that are involved in palm oil, then you can exclude it out. If you have to have the data to know which ones are in. If you want to stay away from companies that are just involved in extreme ESG controversies, you can use some sort of ESG controversy product. So the point is that there's a lot of different types of data and tools that are out there from different ESG providers, research providers, people, consulting teams that are great experts like some of the panelists here. And so the key is get educated about the tools that are available to you, right? Look into those tools, find which seem to be more naturally beneficial to your process. Start with one. Don't make it simple. Start with one. Figure out how to make it work for you. See if it provides benefit to you. So I think that's the way to do it. Don't overcomplicate it. A lot of great people here can really help, put their arm around your shoulder and start walking you down the road, and being of great benefit. And that's the place to start. Talk to an expert. Talk to someone who can really help you make this simple and really show you what that first step could be.
Excellent. Thank you, Ben. Hamish, talk to an expert. How do I find out what's going on, and where do I get my providers from?
Right. Well, I mean, this first slide here really just talks about our benchmarking, our price methodology, and that's really just about prices. So what I would say in terms of ESG, because we're doing this for the whole of the research market, is that and as I've kind of already said, in a liquid market, you tend to get a wider spread. And so I think what's essential, for clients going forward, when you're looking at all those different alternatives, it's understanding, the relative pricing between your various counterparties. Because remember, with ESG, most of the sell side, we'll try and use ESG as a differentiator. So this is a value add. We've got this data, or we've got a certain analysis. The second slide is, the research discovery. So this is something that I spend a huge amount of time on. Is what is out there in the marketplace. So the really interesting thing about ESG, obviously, being a less mature market than the equity market, the fixed income market, etc., is what is out there. And so I think what's important when you're making decisions on those inputs is try before you buy. What are the alternatives? And what is going to fit with your style? And I think the key thing about ESG, there's no definitive process in the sense that it means different things to different people. And so you really need to define what is it that actually we need, because you can look at 10s, 20, 30 different little options, but which one's right for you? And so the service that we provide is really essentially going out and doing that initial due diligence. We don't necessarily provide ratings on all the different providers, whether they're a research provider or a data provider. It's more about, we've done some initial due diligence. This is who the firm is. This is their pedigree. This is what they do. And here's a short list. Take a look and make your mind up yourself and see whether that's going to be a good fit. What we're all about is just making a good match, being a matchmaker in the research market.
Excellent. Thank you very much, and thank you to all my panelists. We at Invisage very much are about taking that data and looking for materiality and looking for investment performance from any piece of research content, whether it be data, whether it be narrative reports, etc. And what I'd like to do now is bring in our CEO, Vishnu Tirupati, to talk about how we do this specifically for tech sector in the context of ESG. Vishnu.
Yeah, sure. Thanks, Bridge. Hello, everybody. My name is Vishnu. I'm the CEO of Invisage. So as Bridge mentioned, Invisage is a research analytics framework that systematically extracts insights from various types of research and data, alternative data. And we help investors integrate those insights into investment decision-making process through our alpha capture framework as well. We highlight sources that are good at a particular asset class, particular security. Now, we have a global partnership with Owl Analytics. We are a distributor as well as implementation partner. And what we are bringing to the table with this partnership is using our systematic approach to integrating data. We take Owl's data and we help each investor contextually looking at their investment universe and creating some of these optimal factor weighted portfolios for them, which are managed on our platform that help them on a daily basis sort of look at how their portfolios are performing from an ESG perspective and how they can rebalance using ESG to do two things. One, how can they improve ESG footprint while not compromising on the portfolio returns? And the flip side of that is how can they make sure they are staying compliant with their ESG footprint targets while improving the portfolio performance, or rather, making sure they're not losing the performance but improving the ESG profile. So we are about to release a white paper that we have done on tech sector as a whole, looking at big tech versus rest of the tech, sort of drawing entire tech sector into two separate buckets. And what we have done is for both of those buckets, we picked these market weighted benchmarks or baskets, and then we said, how can we improve the performance by sort of keeping the ESG footprint intact, right? And what we have seen is we were really overwhelmed by the results within the big tech while keeping the ESG profile intact somewhere around 53 to 56 range. We could improve 6 to 7% annualized performance in the last 10 years. And similarly, 5 to 7% performance within the rest of the tech basket, which is about 300 tech stocks just below the big tech. Again, keeping the ESG profile intact while giving that upside of anywhere between 5 to 7% annualized return. So I think there is a good investment performance potential if one were to systematically use ESG. And that's what our white paper is also going to talk about. And that's how we help our clients.
Excellent. Thank you very much, Vishnu. And I'd like to take this opportunity to thank all of our panelists for taking us very high level with ESG all the way down to the specific processes and products that can help tech investors extract ethical alpha from their portfolios. I'd like to sort of conclude by reminding you all to expect an email from us over the next couple of days with our white paper. Apologies, I couldn't get through all the questions, a lot of diverse topics being discussed. If you have any specific questions for either ourselves or any of our panelists, do get in touch. We'll put you directly in touch with the panelist in question. I'd like to conclude for thanking you for your time, and please look out for the next webinar in our series. Thank you, and have a good afternoon and evening.
Thanks, everyone. Cheers.
Thank you. Thanks.